It's interesting, Kunal, because they are expecting earnings cut on IT and metals, but if you look at the stock momentum, it's quite the opposite.
Well, absolutely, yes, Nisha. And I think, the prices have already started to indicate strong breakout for most of the counters. Now, whether it's the large cap metal stocks, the likes of Tata Steel, etc., even the mid cap names like Hindalco, Jindal Steel have given signs of a breakout. So I think it's a very strong up move for many of the metal names. And we are talking of 2 years and 2.5 odd years of downtrend being reversed for large cap metal names like Tata Steel, the stock which was grinding from 2021 highs, I think of 145 plus, to a point where the stock had fallen sub 100 levels. So it's managed to recover, not just recover in terms of prices, but reverse the pattern of downward sloping trend line for Tata Steel. So I believe that the stock should make a very strong comeback, and I'm assuming that this may not just be a short-lived price action for this metal major. And same is the case with the IT stocks, large cap IT stocks. Even though again they are a bit late in terms of moving towards a swing breakout as compared to the mid cap IT names, but then better late than never for many of these large cap IT stocks, where we've seen TCS, Infosys getting into a breakout mode. These stocks not falling below their previous lows of September 2022, I think is also another additional sign that strength is far more better in IT stocks this time around as compared to the previous time, which was in September 2022.
Actually, this is a discussion you had in the morning as well, right, with Anand talking about the mid-cap space and where there are select opportunities there. Because as per him, yes, you can't paint everything in the same basket, but within their financials and certain pockets do look interesting. And if, in fact, if we have that bite, we should play it up. Because overall, the kind of sense that we're getting is there's definitely quite a few areas of interest. In fact, for IT sector, actually, we spoke with a whole host of experts as well. Listen into their take.
Every year we are going to see the growth. Now this year may be a year of caution, and some of the budgets may have been paused. But next year onwards, we see that return to growth is going to happen. And the IT services spending for the next 3 years is going to be in the double digit, which we have not seen in the past. So I am a bit optimistic from the point of view what we see.
Absolutely. I think selectively, most certainly, more than all out. But yeah, I think that's a stance that we do have. We have a selective stance on the sector. So if I have to name a few stocks within the tier ones, within the large caps and LTI Mindtree, I think is certainly an opportunity. If I look in the mid cap, mid tier IT, then persistent systems. And if one has to look within the small cap space, then Birla Software. I think these would be some names where there is a good opportunity. I think broadly, the mid-tier IT growth outperformance over tier one can continue. Having said that, tier one IT valuations right now are pretty much near the long-term averages. So to that extent, there is some comfort from a valuation standpoint. But at the same time, we do believe that this premium that mid-tier gets on tier one, that's likely to continue much higher levels of sustainable growth.
Okay, let's welcome on board then Sandip Sabharwal as well and chat about what he's making of the market right now. Sandip, hi, afternoon. And sugar, let's talk about that, the sweetest pocket in the market right now. Just wanted to understand, since, you do monitor the sector very, very closely, time to add positions further, or would you say wait it out a little bit and wait for a dip perhaps?
Sugar has been one sector which has not performed despite a lot of things going well for them, both in terms of the weather disruptions in India and globally, which is going to cut this year's production growth. And in some countries, we might actually see declines. We see global sugar prices at multi-year highs. And the concern among the minds of investors has been what happens to the state advised price of sugar cane in an election year where political compulsions might lead the government to increase it more, and that would hurt these companies at a time when Indian domestic prices have increased, but they have increased moderately as compared to what's happening globally. But that said, I think the sector is reasonably well placed. So I would think that it should perform. There should be upside in these stocks, at least 20-30% upside across the board in the sugar sector, because it has not participated at all in the entire mid-cap rally.
The take coming in on the sugar sector. Also wanted to talk about paints because today, of course, the top loser at the index is Asian Paints. Let's look at the other names as well: Berger Paints and Indigo, Shalimar. What are all of them up to? Akzo Nobel, etc. There is, of course, one factor which is crude. It continues to inch higher, so that means bad news for the paint companies. But the other one is also about the launch of Grasim products, because Aditya Birla Group has announced that they're likely to launch its paints business under the brand name Birla Opus, and it's likely to happen by Q4 FY24 itself. And they are planning a total capacity of 1,332 million litres per annum as well. Sandeep, what's your take about the paint segment? Is this something that one should look at incrementally buying, or just stay away because there's a lot of consolidation, a lot of moving factors with crude?
I don't think crude is such a big dynamic, but it is a dynamic. But I think the bigger concern is the increasing competitive intensity. So when JSW paints came in, they also were pretty aggressive, but then they took away some part of the market share. But then the existing players dominated. But Grasim is a whole different cup of tea with their presence across the dealer network and the entire Ultratech network of cement dealers, etc. So I think there'll definitely be a pressure on margins of existing companies as Grasim tries to take market share because the margins of the paint companies are pretty high. So I think it's a good play for Grasim to initially operate with a lower margin and try to take away market share, because I don't think there'll be quality issues with Grasim. So this is a sector where valuations of the companies are still very high. So I would think that investors should shun this sector at this stage, let the shakeout happen, and look at it 18 to 24 months down the line.
Sandeep, as a portfolio strategy, do you think there is a lot of exuberance and froth being built up in the mid and the small cap universe? Do we need to now trim our positions there and perhaps add more to large caps?
Exuberance is there for sure. I think the way the entire mid-cap index has moved, speculative stocks have moved more than the sort of established companies, etc. So there is definitely froth. So we need to be careful what we are buying. There are still opportunities in the mid-cap, small-cap segment where these companies might do well over the next 2-3 years. But anyone buying into mid and small caps right now needs to be very clear that if there is a sudden significant sell-off, sort of trailer of that we saw a couple of days back, then many stocks could fall 10-20% from where they are right now. I think that's the risk which remains in the mid-cap segment. So from here on, allocation should. So I think whoever is fully invested, I think it makes sense to have some cash. Whoever is looking to deploy, I think they should deploy in a phased manner and not jump in right now.
At this one closely, because the entire cables and wire space has again come into the spotlight. The real estate demand is inching higher. There's an entire premiumization at play wherein the customers are going for more branded players. Any thoughts?
I think these valuations are obnoxious, especially for companies in the wire segment. I think I think people have just lost sight of of the fact that these are cyclical businesses. There will be down cycles also, which also last a few years. And finally, these are low margin businesses, wires and cables. And there is very little for one company to distinguish from the other than some brand equity that gets built up. 50-60 times earnings for such company is absolutely abnormal. 2-3 years ago, these companies used to trade at single digit or 10-12 times earnings, and even then people used to think that they shouldn't trade at more than 15 times. Now people think that 35 times on next year forecast earnings also, those forecasts are also so aggressive. I think this is just a frenzy and people should be very careful what they're buying.
Right. Okay. It doesn't end here. And Samit, tell us all about Sami Hotels. Given the excitement in the market around the entire hospitality sector, I'm guessing would find many takers, this one?
Well, I'm not sure whether they'll find takers or not, because but the the excitement that you were talking about. In FY23, all the hotel companies did post record profits, but Sami somehow managed to still report a loss for the third consecutive financial year. That's the detail that we have from FY21 to 23. The company has been continuously reporting losses. Obviously, the company's revenue and EBITDA growth has been much higher than the peers, but that was also because of a low base that the company had seen in FY22. If you see, the company's EBITDA grew by around 8 times in FY23 as compared to FY22. The net debt, now that stands at close to 2,834 crore rupees, and that is the main reason why the company is looking to raise funds. So they are looking to raise close to 1370 odd crore rupees, of which 1200 crore rupees is what they're going to use to repay their debt, while the remaining 170 crore is an offer for sale, where the promoter is looking to offload some part of its stake. Now, given the fact that the company has been loss making and also its debt is high on the book, the valuations are a bit cheaper. The EV to EBITDA for Sami Hotels, if you see, is around 15 odd times, while its peers are trading anywhere between 20 to 27 times when you see EV to EBITDA valuations.
Okay, so that's about Sami Hotels. Thanks, Amit, for joining us. We'll let you go on that note, but let me take forward the discussion with Nooresh as well. Nooresh, from the hospitality sector, which is the stock that you like?
So as of now, a lot of stocks have already moved up in the last few sessions. Only Indian Hotels is one which is retesting the recent breakout of 410, 420 that could again scale up towards the 460 to 480 mark. Then Mahindra Holidays is the one which has still been a major underperformer over the long term. The stock used to be 360, 330 back in 2018 and 300 back in 2010. Gave a breakout, has started a new trend. The first move paused at 365, the next one at 420, and now is consolidating 420 to 400 or 380 rather. So this one could be the which could go towards the 500 mark, and the next one is EIH, which is the best one in terms of the relative opportunity. The stock is available at 240, 250. It used to be 220 back in 2006, 2008. So looks very interesting. EIH would be the top pick now.
Right. Sandeep, there's a Yatra as well, and I guess the IPO is going to be opening tomorrow. I mean, this is a company all of us have dealt with business-wise or consumer-wise at some point in our lives. But what about its IPO prospects?
I think actually I haven't looked at the IPO so closely.
Okay, fair point. Let's just look at what the contemporaries like an Ease My Trip, etc. are up to, and we will just have that stock price, maybe a year-to-date or a 6-month stock price evaluation will just come up for you on your screens. But yes, for the market, it continues to be not been the best of performers. That's down about almost 16% in the last 6 months or so. Continues to be metals, sugar, not much is holding out in the market aside of that. Of course, there is an iShares, M&M, which are also holding out. But just let's map the list of losers. So there's an ITC. We've already talked about how Asian Paints is languishing. But today, the private banks also are not really participating. So ICICI Bank is down about 0.5%. There's Kotak Bank also, which is a laggard. And so is the case with HDFC Bank too. And IT also not doing a whole lot, as I can see on my screens. TCS is at best lying flat, so is Reliance, just marginally soft as we speak right now. But Sandeep, one has seen an interesting trend emerge in the PSB pack, in what the market is now making of private banks, and the fact that most believe that banks is the go-to place now, and largely within the large cap universe. Where do you stand with the banking story, and whether one should dissect it between PSBs and private banks and pick out either of them?
Yeah, I don't buy public sector banks because of various reasons related to governance, the fact that they are losing market share, and the fact that longer term their margins will continuously get squeezed, and the cyclicality on their NPA cycle is much greater than that of the private sector banks. On the private sector side, we've seen consolidation across the board in most large banks. I think one has to make a pick out of what one likes. So I like Axis and ICICI Bank, so I think they look good. IDFC is something we have to keep a lookout on, but then now there's no discount per se, and it's done so well that I wouldn't be a buyer at these prices. HDFC Bank, we need to watch out what happens post the entire CRR, SLR requirements getting met and how it impacts the margins and profits. So I think that could be disruptive for HDFC Bank, at least for 12 to 18 months.
Quite a few disruptions at play there, but PSU banks is something which still do not interest Sandeep. But on that note, Sandeep, we'll let you go. Appreciate you making time for ET now.